You're not losing because of your strategy. You're losing because of what happens inside your head when the trade goes against you. The charts don't care about your feelings. Indicators don't nag you at 2 a.m. Your mind does. If you want to stop bleeding money, you need to stop blaming the system and start fixing the human behind the screen. In the next 20 minutes, I'm going to walk you through the psychological forces that destroy trading accounts, the mental traps most traders fall into, the biases that quietly sabotage your decisions, and practical, step-by-step adjustments you can make today to change your trading for good. First, understand one fundamental truth. A strategy is only as good as the trader who follows it. 7 different traders can use the exact same plan and produce 7 different results. Why? Because one will follow the rules, one will bend them, one will panic, and one will let ego decide. The market's randomness exposes every weakness you have. Strategy teaches you what to do. Psychology determines whether you'll actually do it. One of the biggest psychological killers is emotional reactivity. That's the tendency to respond immediately and emotionally to every movement. You see a red candle, and you panic. You see an opportunity and you FOMO into a trade. Emotional reactivity turns rules into suggestions and suggestions into regrets. It's fast, loud, and persuasive. If your first impulse is to act, you're already trading from the wrong part of your brain. Closely linked to emotional reactivity is revenge trading. After a loss, some traders feel an urge to get it back. That urge is a trap. Revenge trading is driven by shame and short-term emotional relief, not probability. It inflates position size, overrides stops, and turns a single loss into a series. The only thing revenge trading recovers is pain, for a little while, until the market reminds you it doesn't care about your feelings. Another silent destroyer is overconfidence after a streak of wins. Success changes your internal narrative. You feel invincible, you increase risk, you skip risk checks, you stop measuring and start believing. Overconfidence is dangerous because it usually follows a run of small wins that were actually random. When the inevitable drawdown comes, the fall is steep. The surprising truth is that the more you feel right, the more you need to check your numbers. Impatience is a simpler, subtler enemy. It makes you take trades that aren't fully formed, chase entries, and close winners early. You tell yourself you're being proactive, but what you're doing is trading your boredom, not your edge. The market rewards patience. It rarely rewards eagerness. If you trade because you can't sit still, your time horizon is misaligned with success. Now let's talk about cognitive biases, automatic mental shortcuts that feel useful but steer you wrong. Confirmation bias makes you search for reasons your idea will work and ignore evidence that it won't. You'll find 3 indicators that agree and dismiss the 5 that don't. Loss aversion exaggerates the pain of losses and minimizes the pleasure of equivalent gains, pushing you to hold losers and cut winners. Anchoring convinces you to fixate on a price, a past trade, or a target, even when new market information invalidates that anchor. Availability bias makes the most recent or emotional trade loom larger in your mind than the hundreds of quiet, uneventful trades that actually reflect your performance. Emotional amplification is another mechanism to watch. A small loss becomes a catastrophe because your mind inflates it with meaning. I failed. I'm bad at this. I should quit. That cascade of self-judgment leads to desperate behavior. The pattern repeats. Blow up emotionally, trade recklessly, compound losses, and then feel even worse. The loop is brutal because it's self-reinforcing. So what do winning traders do differently? They build structures that remove emotion from the moment of decision. They create rules and rituals and then force themselves to follow them. Here are concrete adjustments you can make, starting now. Write a clear, specific trading plan and pin it where you can see it. The plan isn't optional. It should define your entry criteria, your exit criteria, your risk per trade, your maximum daily loss, and your allowed trade frequency. Write it in simple, unambiguous language. If you can mentally rationalize a deviation, the plan is not strict enough. Use risk sizing to control the psychology. The smaller the amount at stake relative to your comfort, the clearer your thinking will be. If you find yourself making decisions based on anxiety, reduce the size. Make risk boring. Boredom is your ally. It keeps the mind calm, which keeps you rational. Discipline equals freedom in trading. Set maximum daily loss or drawdown limits and stop trading the moment you hit them. This rule acts as a circuit breaker for emotional escalation. You will thank yourself later when your worst day is capped and you can recover with a calm plan, rather than spiral. Keep a trade journal that captures more than just entries and exits. Record your emotions, your physical state, and what you were thinking before and after each trade. Over time, you'll identify patterns. You might trade worse after poor sleep, when hungry, or after watching the news. Those patterns are actionable. If you discover a trigger, change the trigger or the behavior around it. Practice pre-trade checks and a 5-second rule. Before placing any order, pause and ask 3 questions. Is this trade consistent with my plan? Does the risk match my rules? Am I emotionally neutral right now? If you can't answer yes confidently, don't trade. This brief delay interrupts automatic impulses and allows a rational override. Use mechanical entries where possible. Limit orders, automated stop losses, and position sizing rules remove emotion from execution. When you have to decide in the heat of the moment, your chances of following the plan collapse. If your platform supports automation, use it to enforce your rules reliably. Develop a ritual to handle losses. Losing trades will happen. Rather than react, have a prescribed sequence. Step away, breathe for 2 minutes, review the trade in 1 sentence, and record the emotion in your journal. Practicing a ritual will gradually reprogram your reflex. Instead of escalating, you'll default to calm evaluation. Learn to reframe loss. Instead of seeing it as failure, see it as feedback. Ask, what did the market teach me? What data did I not anticipate? How will this stop me from repeating the same error? Shifting to a feedback mindset turns painful events into valuable training data and reduces the emotional weight of each loss. Work on expectations. If you expect every trade to be perfect, you'll be setting yourself up for emotional disaster. Accept that the market is probabilistic. Your job is to stack positive expectancy over many trades, not to make each trade a miracle. When you lower the emotional stakes of each trade, you reduce the pressure that causes bad decisions. Address boredom and FOMO by building structure. Limit the number of setups you will take per day or week. Limit screen time. Decide ahead of time which sessions are for analysis and which are for execution. The more constraints you add that align with your edge, the less likely you'll trade on impulse. Train your physiology. Mental state is tethered to the body. If you're tired, dehydrated, or hungry, your cognitive control collapses. Create a pre-session routine. Hydrate, breathe, check posture, and clear distractions. If you're emotionally charged, angry or excited, do a short walk or breathing routine before trading. Physical rituals have predictable calming effects and help maintain clarity under stress. Develop meta-awareness, the ability to observe your thoughts without immediate reaction. When you catch a thought like, I need to fix that loss now, label it as thought and defer action. Build a habit of noticing and waiting. This simple third-person observation buys you enough time to choose the deliberate action rather than the reflex. Use accountability to strengthen discipline. Share your trading plan and results with a mentor, a peer group, or a coach. Knowing that someone will review your journal makes deviating from the plan costlier. Social accountability is a powerful lever against impulsive behavior. Now, let's get practical about bias mitigation. To beat confirmation bias, actively look for disconfirming evidence before taking a trade. Ask yourself, what would make me wrong? Write down 3 reasons why the setup could fail. This forces a balanced view and weakens your automatic selection of supporting facts. To manage loss aversion, use position sizing that makes losses feel proportional and non-catastrophic. If you can lose a trade without emotional hysteria, you'll make cleaner decisions. Consider also framing wins and losses as part of a process metric. Did you follow the plan, rather than as identity statements? To avoid anchoring, update your reference points. If new market data invalidates your prior view, adjust the plan immediately. Make flexibility a rule. The market is the authority, not your anchor. To counter availability bias, rely on systematic review rather than gut memory. Your journal will show the long-term distribution of outcomes, which trump anecdotal recall of the dramatic trades. One of the most underappreciated actions is to practice no-trade muscle. Use simulation and deliberate practice to train patience. Set days where you only observe and log setups without executing. Over time, abstaining becomes a skill and reduces the compulsive urge to be in the market. Risk management deserves a separate spotlight. Emotional breakdowns often follow concentrated risk. Use position sizing, volatility-adjusted risk, and diversification to reduce the likelihood that a single trade triggers a panic. Define your worst acceptable day and month, and build protective rules: max daily loss, max consecutive losses allowed, and a cooling-off period after breaches. If you do find yourself in a drawdown, resist the temptation to play catch-up. The correct response is to reduce risk, simplify, and return to basics. Drawdowns are an emotional stress test. Your job is to pass it with your discipline intact. Reset your size, review the journal, and rebuild gradually. Another practical tool is the pre-commitment technique. Before you trade, write down your stop, target, and position size. Commit to these parameters publicly or to your journal. Pre-commitment makes it harder to rationalize mid-trade changes because you have a documented baseline to return to. Develop a trading week review ritual. At the end of each week, review your trades, outcomes, and journal entries. Track not only P&L but adherence to the plan, emotional notes, and variance in performance across conditions. Small, consistent review habits compound into large psychological improvements over months. Finally, cultivate patience as a meta skill. Patience is not passive, it's disciplined action. It's the willingness to accept that most days the market offers nothing and that waiting for the right setup is a powerful edge. Train patience by setting intentional constraints. Only trade the best setups, limit the number of trades, and reward yourself for observing rather than acting. Let's finish with a mindset shift that matters more than any single tactic. Move from outcome-based validation to process-based validation. Stop asking, "Did I make money today?" and start asking, "Did I follow my rules today?" If your answer is yes, you are learning to control the only thing you can: your behavior. Profits follow consistent behavior. They don't precede it. You're not losing because of bad indicators or a flawed strategy. You're losing because the human element, your emotions, biases, impulses, and identity, overrides the plan. The good news is that those human elements are trainable. With a plan, disciplined risk sizing, journaling, pre-commitments, ritualized responses to loss, and deliberate practice of patience and meta-awareness, you can change the default behaviors that cost you money. Start small, reduce size, write the rules, follow the rules, journal the feelings, review the data, build the discipline. The market will always offer opportunity and pain. The difference between traders who survive and traders who thrive is not more indicators, it's better control of the person pulling the trigger. Fix the human, and the strategy will finally get a fair shot.